In 1637, a single tulip bulb in Amsterdam was worth more than a house. Within weeks, the market collapsed. Contracts became worthless. Auctions froze. A flower had broken a financial system. But tulips did not begin in Amsterdam. They did not begin as assets. They grew wild across Central Asia. They entered Europe as rare botanical curiosities, exotic, unfamiliar, admired for their color and symmetry. In the Ottoman Empire, they became symbols of refinement and status. By the late 16th century, tulip bulbs reached the Dutch Republic, and in a country already fluent in trade, credit, and contracts, rarity found a market.
Tulips did not begin in Amsterdam. They began in the Ottoman Empire. In the 16th century, the flower grew wild across Central Asia. It was cultivated and refined in Anatolia. Ottoman elites prized it for symmetry, color, and rarity. By the 1550s, tulips were symbols of prestige in Constantinople. They appeared in court gardens. They appeared in textiles. They appeared in poetry. The flower represented refinement, order, controlled beauty. European diplomats stationed in the Ottoman court noticed them. One of them was Ogier de Busbecq, ambassador to the Habsburg Empire. He sent bulbs and seeds west. From there, tulips entered botanical collections in Vienna, then the German states, then the Low Countries. At first, they were scientific curiosities. Botanists studied them. Collectors exchanged them. Scholars experimented with cultivation. The most important figure in this transition was Carolus Clusius. In 1593, Clusius became director of the Hortus Botanicus in Leiden. He planted rare tulip varieties in controlled beds. He documented color variations. He cataloged patterns. Some of those patterns were extraordinary. Flames of white against crimson, feathered streaks across deep purple, contrasts that appeared almost painted by hand. These dramatic patterns were not intentional breeding. They were the result of a mosaic virus that disrupted pigment distribution. The virus weakened the plant, but it intensified visual rarity. Rarity increased desirability. Desirability increased status. Clusius refused to commercialize his collection. He guarded the bulbs carefully. They were stolen anyway. By the early 17th century, tulips had moved beyond academic gardens. They entered private estates, then merchant homes. Owning rare tulips signaled sophistication. It signaled global connection. It signaled participation in a cosmopolitan culture. The Dutch Republic was expanding rapidly during this period. Trade networks stretched from the Baltic to Southeast Asia. Wealth accumulated among merchants and urban professionals. Exotic goods carried symbolic value. Spices, silks, porcelain, and now tulips. But tulips had a distinctive feature. They were seasonal. Bulbs were lifted from the ground only during specific months. Supply was physically limited by growth cycles. Scarcity was natural. Color variation was unpredictable. Scarcity combined with unpredictability creates perceived exclusivity. Perceived exclusivity creates social signaling. By the 1620s, rare tulip varieties were no longer simply botanical specimens. They were collectible assets. Collectors compared varieties. They assigned names. They recorded lineage. Semper Augustus, Viceroy, Admiral van der Eyck. Each name implied uniqueness. Each uniqueness implied value. The transition had begun. A flower once admired in imperial gardens was becoming a structured commodity inside one of Europe's most dynamic economies. Tulips arrived as symbols of refinement.
They would soon become instruments of speculation. By the early 1600s, the Dutch Republic was the commercial center of Europe. Amsterdam moved grain, timber, and textiles across continents. Ships returned from Asia with spices and porcelain. Insurance markets protected cargo. Credit networks financed expansion. Capital moved quickly. Contracts were enforceable. Risk was understood. Paper claims on future profit were already normal. The Dutch East India Company had tradable shares. Investors were comfortable buying ownership they could not physically see. This matters. Tulip speculation did not appear in a primitive economy. It appeared inside a system trained to trust documentation. Urban life amplified this trust. Merchants, brewers, artisans, and professionals lived in dense cities. Information traveled fast. Reputation traveled faster. When a rare tulip variety gained recognition, its name circulated through commercial networks. Ownership became visible. Visibility created status. Status justified price. At the same time, liquidity was expanding. Trade profits accumulated. Savings increased. Reinvestment was expected. Real estate required large capital. Shipping ventures carried operational risk. Government bonds offered stability but modest returns. Tulips were different. They required limited space. They multiplied slowly. Some patterns were unpredictable and rare. Scarcity was built into the plant's biology. Scarcity combined with wealth creates upward pressure on price. By the 1620s, tulips were no longer only botanical curiosities. They were collectible assets. Varieties were named. Lineage was recorded. Prices were compared. The market environment encouraged experimentation. Speculation was not considered reckless. It was considered initiative. Tulip trading began as structured exchange between informed participants. But once a commodity becomes both status symbol and tradable instrument, price begins to detach from utility. It begins to reflect expectation. And expectation, when reinforced socially, can expand faster than supply. The Dutch Golden Age did not create irrationality. It created liquidity. Liquidity seeks movement. Tulips provided it. Tulips did not become speculative assets overnight. The shift was gradual. At first, bulbs changed hands between collectors. Transactions were private. Delivery was physical. A bulb was lifted from the soil. It was inspected. It was planted again. Value was attached to the object itself. But tulips had a limitation. They could only be moved during specific months. For most of the year, a bulb remained underground. This created a problem. Interest in rare varieties did not pause simply because the soil was frozen. Buyers wanted access before lifting season. Sellers wanted to secure future prices. The solution was contractual. Instead of transferring the bulb, they transferred the right to receive the bulb later. A written agreement replaced immediate delivery. This changed everything. Once a contract exists, it can be reassigned. If a buyer believes the price will rise, he does not need the flower. He needs the paper. By the mid-1630s, forward agreements became common. A bulb still in the ground could be sold for future delivery in spring. Payment was often deferred. Sometimes only a small deposit was required. This reduced entry cost. Lower entry cost increases participation. Participation increases liquidity. Liquidity increases price visibility. Soon, the physical tulip became secondary. What mattered was the contract price relative to yesterday's contract price. Bulbs remained scarce. Contracts multiplied. Each agreement represented future expectation, and expectation began to trade faster than biology. Varieties were listed with agreed valuations. Deals were recorded informally. Witnesses confirmed terms. The transaction was no longer horticultural, it was financial. A tulip bulb became a claim. A claim became negotiable. Negotiability increased velocity. Velocity magnifies movement. Rising prices attracted attention. Attention attracted new participants. New participants validated the previous rise. The garden was no longer the center of activity. The marketplace was. And the marketplace was increasingly abstract. The object still existed beneath the soil, but above ground, only paper changed hands. This was the structural pivot. When ownership separates from possession, and possession separates from intention to use, price begins to follow expectation rather than function. Tulip Mania did not begin with flowers, it began with contracts. By 1636, tulip trading had evolved beyond simple forward agreements. It had become a seasonal futures market. The bulbs remained underground through winter. Lifting would occur in spring. Settlement was scheduled for a future date. Until then, contracts circulated independently of the plant. This structure created a new dynamic. A buyer did not need capital equal to the full bulb price. He needed confidence that he could resell the contract before settlement. Obligation was delayed. Risk was postponed. Postponed risk feels smaller than immediate loss. Contracts were often traded multiple times before any bulb changed hands. Each transfer reset expectation. Each new price established a new reference point. Because delivery had not yet occurred, valuation was theoretical. Theoretical valuation encourages momentum. If yesterday's contract sold for 1,000 guilders, today's seller could justify 1,200. If 1,200 cleared, 1,400 no longer appeared impossible. The structure resembled modern derivatives, a claim on a future asset priced according to anticipated demand. But unlike regulated exchanges, tulip contracts were informal. Many required little or no upfront payment. Some agreements relied purely on mutual recognition. Low capital requirement increases leverage. Leverage increases volatility. Participants were no longer primarily gardeners. They were traders, artisans, merchants, brewers, professionals. The objective was not cultivation. It was resale before settlement. As long as a new buyer appeared, previous obligations remained manageable. The system did not require universal belief. It required sequential belief. Each participant needed only one more buyer. As winter progressed, prices accelerated sharply. The compressed trading season intensified activity. Limited time amplifies urgency. Urgency amplifies bidding. By January 1637, some rare varieties reached extraordinary valuations, not because bulbs had multiplied, but because contracts had. The futures mechanism detached price discovery from physical scarcity. Bulbs grew slowly beneath the soil. Contracts multiplied rapidly above it. This imbalance was invisible while demand expanded, because settlement had not yet arrived. But futures markets have a fixed point, delivery day, when expectation must convert into payment, and when postponed risk becomes immediate reality. Tulip contracts were not traded at the Amsterdam Stock Exchange. They were traded in taverns. By late 1636, informal gathering places became active marketplaces. Merchants met in back rooms. Artisans sat beside professionals. Deals were written on paper and confirmed by witnesses. These meetings were structured but unofficial. There was no centralized clearinghouse, no regulatory authority, no standardized enforcement. Trust substituted for infrastructure. Participants often shared social circles. Reputation functioned as collateral. A handshake could validate a contract. This environment lowered friction. Low friction increases velocity. Velocity increases volume.
Volume amplifies price visibility. Because taverns operated locally, trading spread across multiple towns: Haarlem, Alkmaar, Leiden, Amsterdam. Information moved quickly between them. When a rare variety cleared at a higher price in one city, news traveled, prices adjusted elsewhere. Social proximity intensified confidence. When others in the room agreed to rising prices, doubt diminished. Agreement felt like confirmation. The setting also shaped behavior. Taverns are social environments. Conversation blends with commerce. Momentum builds collectively. In formal exchanges, distance moderates emotion. In taverns, enthusiasm compounds. Bidding became competitive. Participants signaled optimism publicly. Optimism encouraged escalation. Most agreements required settlement months later. Immediate payment was rare. Because no formal exchange recorded trade centrally, exposure was fragmented. No participant saw the full network of obligations forming. Each trader saw only his immediate counterpart. This fragmentation reduced perceived risk. Risk appears smaller when distributed invisibly. As winter deepened, trading intensified. Short days compressed activity into evenings. Evenings gathered people together. The marketplace was no longer botanical, it was social. Contracts changed hands in rooms designed for conversation and drink. Price discovery became communal, and communal conviction can reinforce itself rapidly. The tulip market did not require a grand financial building. It required proximity. Expectations circulated faster than bulbs ever could. The tavern had become a trading floor, and the trading floor was built on trust, momentum, and deferred settlement. Tulip Mania was not driven by volume, it was driven by rarity. Most tulips were ordinary, single colors, predictable growth, limited interest. The highest prices attached to broken varieties. Petals streaked with flame patterns, feathered contrasts, unstable color distributions. These patterns were caused by a mosaic virus. The virus weakened the plant, but it intensified visual distinction. Distinction creates hierarchy. Hierarchy creates status. Status creates competition. Competition creates price acceleration. Rare varieties were named individually: Semper Augustus, Viceroy, Admiral von der Eyck. A name transforms an object into an identity. Identity increases memorability. Memorability increases perceived uniqueness. When uniqueness becomes quantifiable, price becomes symbolic. Owning a rare tulip signaled refinement. It signaled access. It signaled participation in elite culture. Scarcity in tulips had three reinforcing features: biological limitation, unpredictable mutation, slow reproduction. Bulbs could not multiply instantly. Certain patterns could not be reliably replicated. Each season introduced uncertainty. Uncertainty increases speculative appeal. If supply cannot be guaranteed, future availability becomes questionable. Questionable availability increases urgency. Urgency reduces hesitation. Participants did not only calculate resale value, they calculated reputation. If a merchant displayed a rare tulip in bloom, visitors observed it, conversation followed, recognition expanded. Recognition reinforced desirability. Desirability reinforced valuation. Scarcity operates differently in social markets than in practical markets. In practical markets, scarcity increases cost. In social markets, scarcity increases meaning. Meaning can expand faster than utility. Tulips had limited agricultural function. They did not feed cities. They did not power ships. Their value was symbolic. Symbolic goods are especially sensitive to narrative. When narrative suggests exclusivity, price reflects aspiration.
By the mid-1630s, the rarest tulips were no longer flowers. They were signals. Signals of wealth, signals of discernment, signals of belonging. Scarcity created the emotional foundation. Contracts later amplified it. The market did not begin with arithmetic. It began with desire shaped by rarity. By early 1637, most participants were not trading flowers. They were trading obligations. A tulip bulb remained underground until spring, yet contracts for that bulb changed hands repeatedly through winter. Delivery was distant. Distance reduces perceived risk. Many agreements required little upfront payment. Some required none at all. Settlement would occur only if the buyer chose to complete the purchase at lifting season. This structure altered incentives. If prices continued rising, reselling the contract was profitable. If prices stopped rising, walking away was cheaper than honoring a loss. Limited downside encourages participation. Participation increases price movement. Because contracts were exchanged multiple times before delivery, the same bulb could anchor several layers of expectation. Each new price appeared to validate the previous one. Validation attracts momentum. Momentum obscures exposure. Participants rarely calculated aggregate obligations across the market. They assessed only their own resale prospects. Individual calculation replaces systemic awareness. The tulip itself did not multiply rapidly, but contractual claims did. This created effective leverage, not through borrowed capital, but through deferred commitment. Deferred commitment expands apparent demand. Apparent demand elevates price. Elevated price reinforces belief. The mechanism was self-reinforcing while growth continued. As long as a buyer existed for the next transfer, the system appeared stable. The obligation was always someone else's future concern. This is the structural risk of leverage without delivery. Value depends entirely on the continuation of resale. If resale stalls, price loses anchor. In February 1637, auctions began failing. Not dramatically at first, simply fewer bidders, more hesitation, silence where competition had been. Without a new buyer, the contract held no immediate utility. Without enforcement, exit became rational. Leverage that magnified gains during expansion magnified abandonment during contraction. The tulip bulb remained in the soil, but above ground, confidence had detached from commitment. The market was no longer supported by physical scarcity. It was supported by expectation of resale. When that expectation weakened, so did price. Leverage without delivery had revealed its boundary. Tulip prices did not rise in isolation. They rose in public. Contracts were negotiated in rooms filled with observers. Transactions were witnessed. Names were recorded. Visibility changes perception. When respected merchants participated, others interpreted participation as validation. Validation reduces hesitation. The Dutch Republic was a reputational economy. Credit depended on trust. Trade depended on reliability. Networks depended on standing. If a brewer or textile merchant entered tulip trading, his reputation traveled with him. Reputation substituted for formal regulation. When prominent individuals purchased rare varieties, the act signaled legitimacy. Legitimacy attracts imitation. Imitation increases demand. Demand reinforces price. This is social proof. People rarely calculate value independently. They observe others. They infer information from behavior. If others are buying, buying appears rational. If others are profiting, profit appears repeatable. The tulip market benefited from this dynamic. Early gains were visible. Contracts resold at higher prices. Stories circulated of successful trades. Accounts of rapid appreciation moved between towns. Success stories amplify participation. Participation amplifies success stories. The cycle reinforces itself. Importantly, tulip trading did not carry immediate stigma. It occurred within the same commercial culture that financed ships and warehouses. Speculation blended with respectability. Because participants were not anonymous crowds, they were neighbors, colleagues, members of guilds. Social proximity lowers perceived fraud risk. If someone across the table shares your network, deception feels less probable. Trust expands exposure. Exposure increases systemic vulnerability. By early 1637, the market had become socially embedded, not confined to elite collectors, not confined to botanists. Artisans participated, professionals participated, merchants participated. When prices rose, confidence felt communal, and communal conviction can suppress caution. Tulip Mania was not only economic momentum, it was reputational reinforcement. Price became proof, participation became endorsement, and endorsement became expansion, until endorsement paused and proof reversed. By January 1637, tulip prices reached their peak. Some rare varieties were valued at several thousand guilders. To understand the scale, context is required. A skilled craftsman in the Dutch Republic might earn 300 to 400 guilders per year. A comfortable canal house in Amsterdam could cost around 2,000 to 3,000 guilders. Certain tulip contracts exceeded those levels. The Semper Augustus, the most famous variety, was reportedly offered at over 5,000 guilders. Whether every recorded figure cleared is debated. What matters is direction. Prices accelerated rapidly within months. Acceleration changes perception. When growth becomes steep, past price levels feel irrelevant. If a bulb sold for 1,000 guilders last month and 1,500 this month, 2,000 begins to feel plausible. Anchoring shifts upward. Participants recalibrate expectations. The shorter the time between price increases, the stronger the impression of inevitability. Winter compressed activity. The trading season was limited. Delivery would occur in spring. Limited time amplifies urgency. Urgency compresses due diligence. Auctions became competitive. Bidding moved quickly. Witnesses confirmed agreements. Contracts were resold at margins before settlement. The physical tulip had not changed. Biology remained constant. But pricing was no longer about horticulture. It was about trajectory. If prices are rising, future buyers are assumed. Assumed buyers justify current bids. This is exponential psychology. Growth appears self-sustaining until it is not. Importantly, not every tulip reached extreme valuations. Many varieties traded at modest levels. But the highest profile examples shaped perception. Outliers influence narrative. Narrative influences participation. Participation influences aggregate price. By early February 1637, the market was operating at its most intense velocity. Contracts were valued according to projected resale. Projected resale depended on uninterrupted demand. Demand depended on confidence. Confidence depended on continuation. The system appeared strong because it had not yet been tested by refusal. The price explosion was not just numerical, it was psychological, and psychology was approaching its limit. In early February 1637, something subtle changed. An auction opened. Bidders gathered. A rare variety was presented. Silence followed. Not panic, not shouting, just hesitation. One missed bid does not signal collapse, but momentum depends on continuation.
Tulip prices had risen because each sale cleared above the last. Each clearing price became reference for the next. When a lot failed to attract buyers, the chain weakened. Reports from Harlem suggest that a scheduled auction did not clear as expected. Participants hesitated. Offers fell below recent highs. Hesitation spreads faster than enthusiasm. If one room pauses, other rooms notice. Contracts depended on confidence. Confidence depended on resale. Resale depended on new entrants willing to pay more. If the new entrant hesitates, the previous buyer holds exposure. Exposure feels heavier when resale is uncertain. The structure had no central exchange absorbing shock. It relied on private agreements. Private agreements rely on mutual willingness. When willingness declines, obligations become negotiable. Some buyers attempted to withdraw. Others sought to renegotiate. Sellers resisted. But enforcement was weak. Many tulip contracts were written with informal terms. Deposits were small. Full payment was scheduled for spring lifting. If the contract price now exceeded perceived market value, walking away was cheaper than completion. Default became rational. Once a few participants withdrew, others reconsidered. The market did not collapse in a single dramatic moment. It stalled. Auctions in multiple towns reported difficulty clearing at previous valuations. Prices no longer escalated, they softened. Softening undermines leverage. If a contract purchased at 2,000 guilders can only be resold at 1,500, the expected profit disappears. Without expected profit, speculative demand contracts. Speculative demand had been the engine. Now it was reversing. Importantly, tulips still existed. Bulbs still grew. Gardens were unchanged. What changed was expectation. Expectation had been forward-looking. Now it turned cautious. In leveraged systems, price declines do not require fraud. They require interruption. Tulip Mania reached that interruption point in February 1637. The auctions did not explode. They faltered, and faltering was enough. By mid-February 1637, the market stopped. Not gradually, decisively. Auctions across multiple Dutch towns failed to clear at expected prices. Buyers did not compete. They waited. Waiting in a speculative market is destabilizing. Tulip contracts had been valued on projected resale. If resale is uncertain, valuation becomes theoretical. When a few auctions stalled, confidence fractured. When confidence fractured, demand contracted. Without new buyers, existing contracts lost reference. Price in speculative markets is not determined by intrinsic worth. It is determined by willingness. Willingness had shifted. Participants who had purchased contracts at elevated prices now faced settlement. Settlement required payment. Payment required conviction that the bulb could be resold at equal or higher value. That conviction no longer held. Because many agreements required only minimal deposits, walking away was rational. Default spread quietly. Sellers attempted enforcement, but most tulip contracts were informal. They were written in taverns, witnessed by peers, not standardized through a centralized authority. Legal clarity was limited. Courts were uncertain whether these agreements constituted binding trade contracts or speculative wagers. Uncertainty weakens enforcement. If enforcement is uncertain, exit becomes attractive. Within days, price quotations became irrelevant. Merchants could list prior valuations, but no one would transact at those levels. A price without a buyer is not a price, it is a memory. Tulip bulbs remained in the ground. Spring had not yet arrived, but the market that priced them had frozen. This was not a physical shortage, it was a liquidity freeze. Liquidity depends on trust. Trust depends on continuation. When continuation is doubted, liquidity evaporates.
The collapse of Tulip Mania was not dramatic chaos. It was the sudden absence of agreement. No panic in the streets, no collapse of the Dutch Republic. But within the tulip market, the chain of resale ended. And when resale ended, so did valuation. The system had relied on expansion. When expansion paused, the structure revealed its limits. The freeze of 1637 was not about flowers, it was about confidence withdrawing simultaneously. And when confidence withdraws, paper promises become paper. The collapse of February 1337 did not destroy the Dutch Republic. Trade continued, ships sailed, markets operated. The damage was concentrated. But who actually lost? Later stories described widespread ruin, artisans bankrupted, families displaced, fortunes erased overnight. The archival record is more restrained. Many tulip contracts were never fully settled. When prices froze, participants renegotiated. Some agreed to pay small cancellation fees. Others abandoned agreements entirely. Because deposits had often been minimal, losses were limited to unrealized gains. The largest exposure belonged to those holding contracts purchased near the peak. If a trader agreed to pay 2,000 guilders for a rare variety and resale collapsed, the paper profit disappeared. But in many cases, the full 2,000 guilders had not yet been transferred. This distinction matters. There is a difference between lost profit and transferred capital. Some professional traders absorbed meaningful losses, particularly those who had resold contracts and faced counterparties withdrawing simultaneously. Chain exposure magnifies risk. If one link defaults, others must adjust. Artisans and small merchants did participate, but evidence suggests they were not universally ruined. The scale of participation was narrower than later narratives imply. Tulip trading was visible. It was discussed publicly, but it was not the foundation of the Dutch economy. Most wealth in the Republic remained tied to trade, shipping, and property. Tulip contracts represented a speculative layer, not the base structure. Losses were real, confidence was shaken, but systemic collapse did not occur. The difference between concentrated loss and societal collapse is critical. Tulip mania became a symbol of irrational excess. Symbols exaggerate, economic records measure. Measured against total Dutch output, tulip exposure was modest. Measured against individual expectation, it was painful. Those who entered late, at elevated prices, without resale opportunity, bore the sharpest impact. Speculative systems distribute gains unevenly. They also distribute losses unevenly. In Tulip Mania, the greatest losses fell on the final holders of contracts, not on the Republic itself. The myth of universal ruin would grow later. The reality was more contained. But containment does not erase consequence. It clarifies scale. After the February freeze, uncertainty spread beyond traders. Municipal authorities were drawn in. Tulip contracts existed in a legal gray zone. Were they binding commercial agreements or speculative wagers? The distinction mattered. If contracts were fully enforceable, buyers were obligated to pay peak prices. If they were wagers, they could be dissolved more easily. In several towns, officials convened to assess the situation. Merchants petitioned for relief. Sellers demanded enforcement. Courts hesitated. Hesitation reflects ambiguity. Tulip trading had evolved informally. Agreements were written in taverns, witnessed by peers, rarely standardized under formal exchange rules. This created interpretive flexibility. In April 1637, proposals emerged to convert tulip contracts into optional agreements. Buyers could cancel by paying a small percentage of the contract price, often cited at around 3.5 to 10%. This effectively capped losses. It acknowledged reality. Prices would not return to January highs. Authorities did not attempt to restore peak valuations. They attempted to stabilize expectations. Stability requires compromise. Full enforcement risked widespread litigation. Complete nullification risked undermining contract credibility. The compromise reduced systemic tension. It signaled that speculative excess would not be retroactively guaranteed, but it also signaled that collapse would not be aggressively punished. This response limited contagion. Tulip contracts were gradually settled, renegotiated, or abandoned under new terms. Importantly, no national bailout occurred. No treasury absorbed losses. Resolution was local, fragmented, and pragmatic. The Dutch Republic prioritized commercial continuity. Shipping, trade, and finance continued functioning. Tulip Mania did not rewrite national policy. It triggered administrative adjustment. Government intervention did not restore confidence in tulips. It contained legal uncertainty. Containment matters in financial systems. When legal boundaries clarify, participants recalibrate risk. The tulip market never returned to its peak structure, but it did not implode into prolonged litigation. Authorities chose moderation over moral judgment. They addressed enforcement mechanics, not narrative blame. The intervention was limited, but it was sufficient. The speculative wave receded. The commercial system endured. Tulip mania is often described as the first great market scam. The word is powerful, but precision matters. A scam implies deliberate deception, a coordinated attempt to defraud participants, an asymmetry of information controlled by insiders. The historical record does not clearly show that structure. There is little evidence of a central organizer. No documented architect designing collapse, no unified conspiracy directing prices upward. What existed was speculation. Speculation is not fraud by default. Speculation becomes destabilizing when price detaches from sustainable demand. Tulip contracts were voluntary. Participants understood they were purchasing future delivery at agreed prices. No one was forced into the market, but incentives were distorted. Deferred settlement reduced immediate risk perception. Minimal deposits lowered entry barriers. Rapid resale encouraged short-term thinking. These are structural accelerants. A market can become self-reinforcing without centralized deception. If enough participants expect resale at higher prices, their collective behavior can create temporary justification. Temporary justification can resemble legitimacy. Legitimacy encourages expansion. Expansion conceals fragility. Fraud requires intent to deceive. Speculation requires expectation of resale. Tulip mania appears closer to the second category. Some sellers may have exaggerated rarity. Some participants may have misrepresented valuation. But isolated exaggeration does not define the system. The system was built on social proof, liquidity, and deferred obligation. It functioned while belief persisted. It stalled when belief weakened. This distinction is important. Labeling tulip mania purely as a scam simplifies complexity. It removes agency from participants. It replaces structural explanation with moral framing. Markets do not require villains to fail. They require imbalance. Tulip mania was a speculative market operating without centralized oversight, amplified by leverage, accelerated by scarcity, and halted by hesitation. It demonstrates how rational individuals can collectively generate unsustainable pricing. The collapse was not engineered from above, it emerged from within. If there was deception, it was not primarily interpersonal, it was systemic. Expectation convincing itself that continuation was guaranteed. Whether that qualifies as a scam depends on definition. What is clear is this: the mechanics did not require conspiracy. They required belief. Tulip Mania did not end in February 1637. The trading stopped. The story began. Within months, pamphlets circulated describing the collapse. Some were satirical, some were moralizing, some exaggerated for effect. Illustrations depicted foolish traders. Scenes showed monkeys bartering tulips. Caricatures replaced nuance. Narrative simplifies complexity. A speculative market becomes a morality tale. Pamphlets framed tulip traders as irrational, as greedy, as disconnected from reality. But satire serves more than entertainment. It shapes memory. Printed pamphlets in the Dutch Republic spread quickly. Urban literacy rates were high. Printed material influenced perception beyond direct participants. The image of Tulip Mania as mass insanity gained momentum. Stories described entire fortunes lost, families ruined, cities destabilized. Archival records do not fully support those claims. Losses occurred, but systemic collapse did not. Why exaggerate? Because crises invite explanation. Explanation often prefers moral clarity. Greed is easier to narrate than leverage mechanics. Foolishness is easier to depict than deferred settlement structures. Tulip Mania became symbolic. Symbolic stories travel farther than economic detail. The monkey trading tulips became more memorable than the legal debates over contract enforcement. Media amplification altered scale perception. An event affecting segments of traders became a cautionary tale for all commerce. Over time, repetition hardened narrative into assumption. Tulip Mania was cited as proof of collective madness. Proof that markets are inherently unstable. Proof that speculation inevitably destroys societies. But the original episode was narrower. It involved specific contracts, specific towns, specific participants. Media did not invent the price rise. It amplified the collapse's meaning. Meaning influences future interpretation. Later generations encountering financial volatility invoked Tulip Mania as precedent. The story detached from its precise mechanics. It became metaphor. Metaphors compress detail. Compression reduces structural understanding. Tulip Mania's afterlife was shaped not only by economics but by storytelling. The pamphlets outlived the contracts, and narrative proved more durable than price. Tulip Mania is often described as a national disaster. The image is dramatic. Merchants ruined, homes lost, the Dutch economy collapsing under speculative excess. The historical record does not support that scale. Trade continued after 1637. Shipping expanded. The Dutch East India Company remained active. Urban growth did not reverse. Tulip contracts represented a speculative layer, not the economic foundation of the Republic. Most wealth remained tied to commerce, property, and global trade. Some traders suffered losses, particularly those who entered near the peak. But many contracts were renegotiated. Some were canceled for small fees. Others simply dissolved when counterparties withdrew. Losses were real. They were not universal. The myth of total ruin emerged later. Moralists preferred catastrophe. Writers preferred cautionary drama. Future commentators preferred a clear warning symbol. An entire nation driven mad by flowers is memorable. Localized speculative losses within a broader stable economy is not. But accuracy matters. The Dutch Republic did not implode. Banks did not fail. International trade did not freeze. Tulip Mania was disruptive. It was embarrassing. It exposed speculative fragility. but it did not dismantle the system. This distinction changes interpretation. If Tulip Mania destroyed a nation, it proves markets are inherently catastrophic. If it caused concentrated losses within a resilient economy, it proves something different. It proves that speculative bubbles can inflate and deflate without ending the underlying structure. The myth exaggerates scale. The records constrain it. Understanding Tulip Mania requires separating narrative drama from measured impact. The collapse was sharp. The consequences were contained. The system endured. Tulip Mania did not remain a 17th century episode. It became a reference point. When the South Sea bubble inflated in 1720, commentators invoked tulips. When stock speculation surged in the 19th century, writers recalled Amsterdam. When technology stocks collapsed in 2000, Tulip Mania resurfaced. The episode became shorthand, a flower equated with financial madness. But repetition alters emphasis. Each later crisis reshaped the story to fit contemporary fear. In Britain, Tulip Mania was cited to criticize joint stock excess. In the United States, it was invoked during railroad speculation. In the 21st century, it became a comparison for cryptocurrency volatility. The original mechanics were rarely examined closely. Instead, the symbol carried the argument. Tulip Mania became a rhetorical device. If prices rise quickly, someone mentions tulips. If valuations detach from fundamentals, someone references Amsterdam. The story gained portability. Portability increases influence, but portability reduces precision. The actual Dutch tulip market was specific, limited in scope, embedded in a particular legal and social structure. Modern markets differ in scale and infrastructure. Yet the emotional pattern feels familiar. Rapid price increase, public enthusiasm, late entry at elevated valuations, abrupt reversal. These elements recur across centuries. Tulip Mania survives because it compresses them into one image: a beautiful object, an extraordinary price, a sudden fall. The warning is simple: excess invites reversal. But the deeper lesson is more structural. Speculative systems amplify expectation. Expectation reinforces pricing. Pricing encourages participation. When participation slows, reversal accelerates. Tulip Mania became shorthand for that cycle, not because it was unique, but because it was early, and early examples become archetypes. The flower outlived the contracts. The metaphor outlived the market. Tulips became a permanent cautionary reference, even when the underlying episode was more contained than legend suggests. Tulip Mania is often described as unique. It was not. Its structure has reappeared repeatedly. The South Sea bubble in 1720 followed a similar pattern. Shares priced on projected future gain, expansion fueled by confidence, collapse triggered by hesitation. The railway speculation waves of the 19th century repeated the sequence. Infrastructure promised transformation. Capital flooded in. Valuations outran revenue. The dot-com surge of the late 1990s echoed the same logic. Digital companies promised future dominance. Investors priced expectation rather than earnings. Momentum replaced cash flow. Cryptocurrency cycles in the 21st century have followed comparable dynamics: limited supply, high volatility, community-driven enthusiasm, rapid repricing. The asset changes. The mechanics remain. Tulip contracts were leveraged through deferred settlement. Modern derivatives use margin accounts and structured instruments. Different tools, similar exposure. In each case, rising prices create validation. Validation attracts new entrants. New entrants sustain price acceleration. Acceleration reinforces belief. Belief expands participation. Participation increases fragility. The turning point is rarely fraud discovery. It is interruption. Demand slows, liquidity thins, confidence adjusts. In highly leveraged environments, small hesitation produces disproportionate effect. Tulip Mania demonstrates the blueprint clearly. Scarcity narrative, accessible entry, deferred obligation, public reinforcement, rapid repricing. The Dutch episode was limited in scale, but it revealed a pattern that later markets amplified globally. Technology and regulation evolve. Human response to price momentum remains consistent. Speculative markets do not require deception to inflate. They require alignment of expectation. When expectation is synchronized, price can detach from measurable value. When synchronization breaks, price recalibrates abruptly. Tulip Mania was not an anomaly. It was an early case study, a compressed demonstration of speculative contagion. The blueprint did not disappear in 1637. It expanded.
Tulip Mania endures because it feels absurd. A flower valued above a house. But absurdity is not the lesson. Structure is. Tulip trading began with rarity. It evolved through contracts. It accelerated through leverage. It expanded through social proof. None of those elements required deception. They required alignment. Alignment of expectation. Alignment of confidence. Alignment of resale belief. The market functioned while continuation was assumed. When continuation was questioned, valuation recalibrated. This is the structural core. Speculative systems are not sustained by objects. They are sustained by belief in future liquidity. Liquidity depends on participation. Participation depends on perceived upside. Perceived upside depends on prior price movement. It is circular. Circular systems are stable only during expansion. Tulip Mania did not collapse the Dutch Republic. It did not end global trade. It did not dismantle financial innovation. What it revealed was fragility within speculative layers. Layers built on deferred commitment. Layers built on resale expectation. Layers built on momentum rather than production. Closed systems redistribute. They do not generate. When inflow exceeds outflow, distribution continues. When inflow slows, redistribution halts. Tulip Mania was not primarily about flowers. It was about how markets transform narrative into price. Narrative can elevate value rapidly, but narrative cannot replace external anchor indefinitely. Anchors are production, cash flow, utility, sustainable demand. Without anchor, price depends on continuation. Continuation depends on confidence. Confidence is volatile. The tulip bulb remained in the soil throughout the crisis. Biology did not change. Expectation did. Tulip Mania survives because it illustrates a repeatable dynamic. Scarcity, speculation, acceleration, interruption, repricing. The asset changes across centuries. The sequence does not. The first market scam may not have been a coordinated fraud. It was something more instructive. A demonstration of how belief, when synchronized, can temporarily override fundamentals, and how quickly fundamentals return when belief withdraws.